Hello, everyone. Welcome to today's webinar, Career Insights, Future of Investing Careers with AI and Alternative Data, hosted by CFA Institute and CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. I'm Litesh Gada, CFA, founder of Aureus Assets. Aureus Assets is into financial services, providing services like business consulting, valuations, transaction advisory, and research. Before I introduce our speaker for the day, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A, 45 minutes of presentation, and last 15 minutes will be for Q&A. We will be leaving enough time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off today. Now it is my pleasure to introduce our speaker for today's webinar, Nirav Shah, CFA. Nirav is founding partner of Versor Investments. Nirav has more than 18 years of experience in quant research, asset allocation, and scalable systems. At Versor Investments, Nirav serves on the management committee and is also head of India office. In his role, Nirav assumes leadership of critical functions including trading, technology, infrastructure, HR, and management of client relationships across Asia. Before his tenure at Versor, Nirav was the founder of a consulting firm focused on quant research. Earlier in his career, Nirav was a VP at InvestCorp in New York, focused on asset allocation and quant research. He worked as quant researcher at Phoenix Global Capital Management, a commodity trading advisor based in Chicago. Nirav earned a master's degree in finance from Illinois Institute of Technology, Chicago, and bachelor's degree in computer engineering from Mumbai University. Nirav is also a CFA chartered. Over to you, Nirav.
Thank you, Litesh, for the kind introduction. I also want to take a minute and thank the CFA Institute and the CFA Society India for giving me the opportunity to present this webinar. Today on the agenda, what we have is we'll start with, we'll talk about what is AI and what are the challenges and advantages of using AI in investing. We will talk about alternative data sets and how to approach them. We will share, we'll see some case studies on how AI, ML, and alternative data is used in the investing process. We'll talk a little bit about the other use cases of AI in finance and other industries. We'll talk about what kind of new roles are available in finance and under the aegis of AI and ML. And then finally, I'll share some basic, simple tips to do well in interviews. Let me move forward. So to start with, I thought let's talk about, some of the buzzwords that are there today and what do those mean, right? So AI or artificial intelligence is a broad field that aims to create machines or systems that can perform tasks that would typically require human intelligence. Now, it's needless to say that as investors, we are focused on building systems that not just replicates, but exceeds human intelligence. Machine learning is a subset of AI that focuses on building predictive algorithms and models by learning from large amounts of data. Typically, when people talk about AI in finance, they mean machine learning, which is just basically models that have been developed using large amounts of data. NLP is a type of machine learning where models are trained on large corpuses of text with the goal to understand, interpret, and generate human language. ChatGPT, which is currently in the consumer psyche because of its impressiveness, is a specific type of NLP model that's developed by OpenAI, where GPT stands for generative, which means a type of model that can generate new, previously unseen content. Pre-trained, which is a very, very fancy way of saying that the model has been trained on a very large data set. And transformer, which is a specific type of deep neural network that is a foundation of all large language models. So the need for why do we need to integrate AI, ML, NLP, right? We need to do that to enhance the data processing, to improve decision making in finance, and to get a competitive edge in the investment process. So to start with, I want to focus on some of the challenges that are there in using machine learning or AI in finance. The first challenge is that we work in finance, and generally in finance we operate in a very low signal to noise environment. And what that means is that for machine learning models, the propensity to overfit is very high, and it is very, very easy to confuse noise for signal. What that means is, one, it's not only just very difficult to extract data, but it's also very, very easy to sort of consider noise as signal. The second issue that is there in this framework is that machine learning algorithms typically are applied in settings where there is no noise in labels and features. What that means is, say, in computer vision, when you talk about a picture of a cat, it is really a cat. There is no ambiguity. But in finance, there is a little bit of ambiguity. You and I can look at a series of returns and come up with simple different rules. Say, any return more than 100 basis points is good. Any return less than 100 basis points is bad. And we can tag it accordingly. So there is a little bit of subjectivity, which makes machine learning difficult to apply in finance. The second challenge is non-stationarity. Most machine learning algorithms and methodology designed for IID data, what that means is it expects the data to be stationary. But what happens is, in reality, is market participants adapt to events happening in the market. So the market is not constant. There are regime changes, there are patterns that change over time. And the third challenge that is there in using AI in finance is that a lot of the AI models try to balance between false positive and false negative. What that means is they try to balance between, say, aversion to losses and the opportunity cost. But in reality, we as investors are more focused over aversion to losses and less on the opportunity cost. The another challenge that comes in with unsuitable metrics is a lot of the AI models use mean square error, which tries to minimize the average loss on an entire data set. But in reality, what we want to do is we want to focus, in a distribution, we want to focus on the tails where your forecast estimates are high enough to overcome transaction costs. So there's no point in making very, very small return forecasts that you cannot take advantage of it, because the transaction cost would sort of eat away that alpha. So these are some of the challenges that are there in AI models. But there are distinct advantages, which is why they've been used very widely. First, AI models are able to capture complex non-linear relationships, which were previously unlocking hidden alpha, which were not previously accessible. What does that mean? So the chart on the left shows bad alpha signals and good alpha signals. And what AI does a very good job is on identifying those signals that lie at the interaction between the two. So any signals that are cross interaction, that are non-linear, AI techniques, ML techniques do a very good job in identifying those. The second advantage is there is a large amount of different techniques that are available for use for investors or practitioners. And there is a large variety of use cases available, which is really not there in the realm of standard statistics. Here, there are some of the techniques that we've used: decision trees, neural networks, dimensionality reduction techniques, clustering methods. And this is just an illustrative list. There are constantly new AI techniques that are becoming available, and these get applied across a wide range of applications, right? So they get applied on alpha generation process, they get applied in risk management, they get applied in portfolio construction. So across the investment process, there are multiple different applications of AI model. Alternative data what we internally define alternative data is any data set that is less commonly used by market participants and has been collected without the primary objective of being used in financial investing. This definition is deliberately a little vague because the definition of alternative data keeps changing. What I mean by that is something that was alternative data 10 years ago is available easily today, and it's no more alternative. Everybody can use it. So as market participants become more and more savvy, the definition of alternative data keeps changing, which means that as an investor, we need to keep looking at new data sets. There are three main points that I would like you to take away from this slide on alternative data set. First, alternative data sets is it's a natural extension of alpha signal research process. As quants, what we look for is stable, regularly updated data sets that can generate recurring return forecasts. So if you look at the funnel on the right, the first most important thing that we have put in is the sourcing of alternate data set. We need something where we can apply a scientific hypothesis-driven framework, asking what is the causal predictive relationship of the data with the tradable asset. Does the data have a causal link with the asset or returns or revenue, whatever we are trying to predict? The second thing that I want you to take away from this is today in 2023, machine learning is table stakes. These alternative data sets are very large, structured, and high dimensional, and using traditional statistical methods don't work anymore. It is not enough to use simple factors like aggregate moving averages or just aggregating data. We need to use machine learning to sort of construct composites and combine data sets and get value out of that. The third key point is that framing the problem is key. Even if you access an alternative data set and then use it for framing something that is very direct, like say returns, there may be no more alpha available in it because it's very competitive. Everybody else is looking at it. So you may have to convert that data set into something else, something you have to apply financial creativity and intuition, maybe convert it into ranks or a classification problem, forecast some outperformance or underperformance, and then use that in your investment process. So the key point here is just directly using data is not enough. There has to be a financial intuition in what we want to extract out of it. The three funnel that we show on the right are the three sort of steps that get involved in the alternate data set. So sourcing, evaluation, and deployment. Typically, if we look at the effort that sort of goes into this, sourcing takes about 40% of the effort, evaluation 40%, and 20% goes into the deployment. Next, I want to spend some time on sharing some case studies on alternative data sets. These are hypothetical case studies, but it will give you a flavor on how it is being used in the investment process. So one of the data set that's very widely known is consumer cards, credit card information. And credit card information is used sort of to predict the revenues of consumer companies, right? So if you take a retailer, a large part of the retailer's revenue comes through credit card spending. So if you have real-time credit card data, you can use that to sort of estimate the revenues before the actual revenues comes out by the company, right? So that is one way people use consumer card data. And there is a relationship. So the chart on the left sort of shows the correlation between the forecasted data using credit card revenues and the actual growth. Right. But now again, this is one example where as more and more people use, the direct prediction of revenues may have now lost alpha. So you have to be more ingenious, more creative on deriving insights from this data set. A second case study that I want to talk about is using news sentiment. So everybody is aware of, say, price momentum, right? Which is just the momentum in prices of equity or any other asset class. An alternative way of looking at momentum or sentiment is saying, okay, can we go and look at the sentiment of users for that particular company or product? And that can be derived from news articles, that can be derived from social media articles. So the case study on the left is essentially saying use news. So use NLP languages to sort of parse through social media, pass through news articles, and get a real-time time series of sentiment on companies, and then say, does that have some kind of a predictive power on the returns for those companies? The case study on the right, the third one is essentially looking at sentiment, but not from a user perspective, from a management perspective. So again, applying NLP, natural language processing models on an earnings call transcript and saying, is there, based on the tone of the management, based or the kind of words that they have used in their earnings call, can we come up with the sentiment? Is the sentiment positive? Is the sentiment defensive? Is it neutral? So, there's some examples here. So, for example, from the IBM earnings call, the first example is a positive phrase for every event type product. So they have used a sentence which says, and in Australia, we are working with banks to launch new commercial property based on blockchain. Similarly, there is a phrase that is sort of a negative sentiment. And then the third is, so it is what this does is it allows you to come up with sentiment scores based on the language, and then to see, is there predictive power in that versus the performance of the stock going forward, right? So these are some of the ways in which alternative data sets and machine learning models are being used in the investment process to gain an edge. The fourth case study that we have, so the first three case studies are things that several of you may have already seen before. This case study I wanted to put in is because a lot of people may not have seen it. So B2B SaaS reviews, right? So the B2B companies are online software providers. These companies typically sell their products online. So the genesis or the hypothesis for this particular set of signals is that for these online software provider companies, a good estimate of the sentiment is in the user reviews. The reviews that different users put in for their products may have a sentiment and may have some alpha in there. So what we have done here is we have gone to the top 5 websites for user reviews and collected the reviews out of that. So it's about 5 million data points. So that's a large data set. Why a couple of things to note here is, one, for these products, there is no physical store. So there is no physical geolocation data available to estimate, what will be the revenue, will there be revenue increasing? And also online geolocation data like number of users on their website is not necessarily linked to their revenues, right? It could be an attention seeking mechanism, but it does not translate to increase in revenues. Similarly, credit card credit card data may not be a good fit here, because for a lot of these companies like AWS, Snowflake, Azure, the spending that is done by a company on those platforms is way more than credit card limit. So usually these payments are not done through credit cards, right? So how do you estimate the sentiment? What we've done here is, so on the right, what we have done is we have taken one user sentiment for NetSuite, which is a product of Oracle, and we fed that to the current favorite model, which is ChatGPT, to get a sentiment score on that review. So the box on the right, bottom right, sort of we fed the review to it and we get a sentiment score. Now it's important to note, here, this is an illustrative example. So ChatGPT may not be the best model for something like this, right? It is not necessarily trained to evaluate content like this. Also, ChatGPT has been trained on data till date. So if you're trying to then use this to estimate something 5 years ago, then there could be a forward bias in it. But this is like an estimate to get some kind of a sentiment score. And the way an investor can sort of take advantage of this is to create a combined score of all the sentiments across all the products of a company, and then look at a time series of it, and then say, okay, relative to the history, has the sentiment changed, or is there, look at the dispersion of the sentiment and say, okay, is there some new information in there, and then evaluate, does that have some kind of a predictive power in what we want to do in revenues or returns or things like that. So the point I'm trying to make here is that, one, the alternative data sets are unique data sets which others are not looking at. There is effort and it's messy, so there's effort involved in sort of cleaning it up and setting it all up, but then that is what gives the investing edge. Third is, you need tools to be able to analyze something like this. And then fourth is how and what you are trying to derive out of the data set is equally important, right? So it's not just about, okay, let me take all the data, give it to a model and see what the model throws. No, there is a scientific, creative aspect to first identify, is there a causal link between the data that we are analyzing and what we want to predict? How do we meaningfully extract the information using advanced AI machine learning techniques? And then, how do you then sort of build that relationship and use it in your investment process? So that's a little bit on the how alternative data sets and AI ML is used in the investing process. I just want to touch upon other fields related to finance where it is being used. Wealth management is something where AI will be used more and more. It will be used for customized asset allocation decisions. It will be used in customer engagement. That aspect is actually applicable across industries. It will also be used for compliance and reporting. In forensic finance, fraud detection, AI is already being used across several places, across, to flag money laundering. Across investment banking, it is being used to create vast data sets. It is used to create pitch books. It's extremely easy to create materials, presentations using AI-based apps. And it improves productivity, and we would see that happening more and more across various industries. Similarly, it also has applications across corporate finance. If we just step away from finance into other industries, I think AI and ML have vast applications across everything, and it will impact and touch every aspect of our life. Within healthcare, we see it being used for patient monitoring. We have members of our team who have worked on who have worked as part of their PhD on projects like identifying the probability of getting cancer from images of the retina of the eye, or looking at relationships between DNA and genes and diseases to find if that can predict the occurrence of a disease. So within healthcare itself, there is a lot of application of AI. As humans, as we generate an enormous amount, exponential amount of data, that data will be used across industries, in most cases to improve productivity. It is also being used currently for drug discovery. Autonomous vehicles is well known. There are several companies working in advanced stages of that. E-commerce, again, we are already experiencing it, across recommendation engines from Netflix to engines from Amazon. We experience e-commerce everywhere, same on Google Ads that we see. So again, a large number of industries outside of finance will also be impacted, and AI ML will be used. In fact, in several of these industries, due to the cases that I mentioned, like non-stationarity, the data not being noisy, the labels being clean. In fact, it's easier to apply. In finance, it's more difficult because the markets keep adapting, and the data is not necessarily as clean. I also want to sort of spend a couple of minutes on, if you are thinking about AI, what do you think about from a technology perspective? It is, what kind of technology stack that we look at. This is a very high level. The first set is, the data warehouse, kind of, how do you store the data? Where do you store such large amounts of data so that it gets processed, cleaned, and becomes available for researchers to use further? So there are a series of companies available and providing very easy to use data sets and data storage mechanisms and data warehousing mechanisms for that. Compute power is needed for the models to learn and be able to predict. There is a lot of computation involved. There is a ton of processing needed. Again, all the large platforms starting from AWS, Google, Azure do provide very easy to use interfaces for running these computations. This is an illustrative list. More and more companies are providing it. Models, again, so the large platforms that provide computation provide models. But in addition to that, there are specialists who also provide a lot of models to run these AI-based algorithms, right? So OpenAI is the most famous, but there are several more. And each one of them have different versions of models. Each one of them have different versions of the various data sets on which those models have been trained. And as a researcher, you can take these as your base, but actually build on it. So a lot of the work that gets done is not just use these models as it is, but that's a starting point. And then to optimize them, to do hyperparameter or tuning, to build on these models by adding your own intuition, your own domain knowledge into it. And then the last step is then getting applications across text, image, video, code, speech, multiple, right? One, I would again give an example of coding where we use multiple AI models for helping just improve productivity on the coding side, and it has improved human productivity multiple times, because you have to just write in English, like load so and so data and set it up in so much dimensions, and then the code will get generated for it. So it has just improved the productivity across dimensions. So moving sort of into roles. So the roles that are available in the investing world are changing, right? And there are some existing roles where participants need to adapt, and there are new roles. So data engineer is a role. The responsibility is for assembling and managing data sets used by AI systems, maintaining these data lakes and the networks that power the AI systems, ensure accuracy and completeness. So there are three big qualities, data or responsibilities: data collection, infrastructure, data quality. Now, this is very interesting, and I'll tell you why this is relevant for a lot of the people here looking at careers, right? Over the years, I have come across several technologists who have done their undergrad in technology and are strongly interested in finance. And they're often lost as to how do they make the transition. Several of them, give CFA exam, which is one good step, but that also is a multi-year process. And they are not necessarily sure what to do in that meantime, right? So if you are a technology specialist, you are interested in finance, you are giving your CFA and moving in that direction, if you can apply your skills as a data engineer, you immediately get a head start, and you can now play on your strengths. You bring something to the table from a technology perspective, and then apply it in the domain of finance. So it's a combination of that. It's true for data engineer, true for a software engineer role also, which sort of I'll bring up later. The second role that is there is a data scientist, quantitative researcher. The objective here is to basically do model research and development, identify alpha, run optimizations, do the algorithm optimizations, right? So we have to, we spoke about how the algorithms need to be retrained. There is hyperparameter tuning. So all of that feature engineering, all of that is needed. The skill set for this particular role is to be very good in programming languages. Python is one of the most widely used. There are several more. You have to be comfortable with statistical analysis, with backtesting of models, and also understand how the signals or the alpha that you generate will be used in portfolio construction and risk management. The financial analyst role, right? This is a role that is existing today. A lot of the financial analysts are discretionary managers. But there are things that you can do, even if you do not have a technology background, even if you do not have a mathemat or a computing background. There are things that you can do today to sort of contribute in this process. I think the first is data analysis. Data, one of the things when we're talking about alternate data, we said was applying financial intuition in how to use the data, what to extract out of it is critical. This is the place where a financial analyst can help, working closely with the quantitative researchers, with the data scientists on sort of interpreting the data correctly is something that you can help with. A lot of the discretionary analysts use the outcome of AI models to combine with their reviews or with their analysis of companies, right? So they would have done a fundamental analysis of their companies, but now the output of AI, say real-time revenue forecast or sales growth forecast, is now part of that analysis. So even though you are not involved in generating that data, you have to be comfortable enough to be able to use it intelligently in your analysis. So that's part of the investments. And a third thing is, in a lot of these cases where we talk about alternate data, I think the third critical part is also in terms of implementing the portfolio, the live trading, keeping transaction costs lower, making sure, what is adding value, what is not adding value, are the signals really working? So doing that analysis of your portfolio and giving feedback back, or then taking decisions on what kind of tweaks need to be done, what kind of new data sets need to be explored, I think is another part of the role that a financial analyst can now do, in addition to whatever the responsibilities are there today. Portfolio manager as a critical role. As a portfolio manager, I think one clear part is the standard generic portfolio management role. So that is universe selection, asset allocation, portfolio construction, risk management. The second is trading. So liquidity management, performance evaluation, transaction costs. But a portfolio manager does also have a role on the research side. The first critical aspect is data sourcing, right? The identifying what data sets make sense, what is the kind of alpha we want to extract out of it, the AI outputs, do they make sense, right? The portfolio manager would have the best financial intuition to make sense out of the data. Just generating outputs of data is of no use without the financial intuition. So the portfolio manager plays a very critical role. And as a portfolio manager, it's important to understand how these models work, even if you're not developing them yourselves, understanding what are the kind of outputs these models give, and then to use it in your investment process. I think the new age of investing requires combining, even if you're a discretionary manager, combining the existing way of doing things with the new AI ML way of looking at investments. Software engineer, core part of building these algorithms. It's important, they're strong in programming languages, helping develop backtesting architectures, building a lot of reports. As you integrate AI in the investment process, it's very critical to get feedback on how it is adding value. The software engineer works closely with the analyst or the portfolio manager to sort of, come up with reporting around that. Financial just things around systems, right? Trading systems, cloud systems, middle office operations. So that's sort of some of the roles which get impacted by AI. Final sort of couple of slides on what can one do, because it's a career webinar. What can one do to sort of, do well in your interview process? Over the years, I have been involved in the hiring process at my firm. And, there are just simple tips, but I think they do work. First is perfecting the resume. So I think it's important that you understand the role, align your resume with the role. The job description that you see is always the best starting point. Beware of buzzwords. Do not just put in buzzwords. That's often negative if you have not really done work on it. If you're starting your career, you're just out of college, find relevant internships for your goal. Unpaid internships are okay. We often see on social media people saying unpaid internships are not okay. They are okay because they give you that head start on the kind of experience you want. And over time, from your success perspective, it more than enough makes up. I think everybody has to appreciate that when somebody is coming in raw from school, the companies do put in effort in training people there. Do relevant projects. I think that's very critical for the kind of work and role you want to do. Do relevant projects so that you can talk intelligently about it. And certifications, CFA, FRM, others work. In addition to this, CFA Institute has a very good data science certification program too. It's again very helpful in for analysts or portfolio managers, sort of who are not technologists or not quants, to understand what are the components in there. Second is reaching out. So connect with current employees, ask for referrals, ask for advice on who is hiring, who matters. Reach out to HR leaders, and in general, just reach out to CFA India Society or any CFA Institute alumni networks to build connections with your target companies. And last but not the least, I think these three characteristics help stand out. They are very commonsensical, very obvious, but we often don't see people apply it. Be detail oriented. If you have something on your resume, know it in depth. I think that always helps you stand out. Do not put in buzzwords where then you don't know enough about it. That's negative. I think companies understand that everybody cannot know everything, but what the expectation is, whatever you say you should know it well. Demonstrate deep technical knowledge and domain expertise in whatever you do. Whatever you do, it doesn't matter. You do it well, and that is what usually companies look for. Have a genuine research interest in the company. So research the company, go to their website, identify what are they doing, align your career goals with the role. I think that is very critical. And ask questions. I think when you ask questions as part of the interview process, I think it definitely shows interest, and that helps you stand out. And last but not the least, be genuine. It's okay if you don't know something, be honest about it. Write a thank you email. In India, I don't see that a lot. Outside of India, when we are hiring globally, we see that always. I think writing a thank you email goes a big way. And then seek feedback. I think there is no harm in seeking feedback. It helps each one of us improve. And I think these are some of the things that will help you navigate the interview process. So I think that's it from my side. Thank you, everybody, for listening to the webinar. I appreciate the opportunity.
Well, thank you, Nirav, for the wonderful presentation. As a reminder to the audience, you can submit questions through the Q&A link at the bottom of the screen. Nirav, in terms of the whole presentation, and it talks about a lot of technology somewhere or the other, is it like somebody has to be a tech expert when he is looking at investing based on quant and AI, ML, or a normal finance guy also can look for opportunities in this sector?
So for a non-tech person, the opportunities will be on application of the output of the models. So I think understanding the financial intuition, the causal link, and sort of helping researchers with what is the right kind of data that they should use, that they should look for, what kind of relationships they should look for, I think is a big way where a non-technology person can add value. Another way a non-technology person can add value is looking at the data sets and understanding the core data sets. At the end of the day, the machine learning models, the AI models are trained using data, and looking at the data and giving insights, helping it set up properly, helping it normalize properly is again a very big area where the data scientists, because they don't understand the domain, it may not make sense for them, right? But a financial specialist, an analyst will understand the domain and say, okay, certain data doesn't make sense. You have to sort of, it doesn't make sense, and it has to be handled differently.
Right. So typical, like all the tech companies where there are coders who will write codes for you on the tech piece, and there will be functional guys who will be able to pass on the functional knowledge of what is the kind of output which is required. And if you are having both the sides of in the sense knowledge on both the sides, then it is the ultimate thing. Else, also you will be able to make a career out of it.
Yes, definitely. That is absolutely true. I think the key point is that for again, a lot of users are from India. There are a lot of people with technology background in India, so computer science graduates, other engineering graduates, who genuinely have an interest in the financial world, and often they were not able to make a switch because just okay, I've already spent few years working. How do those years may go waste? I may have to give up the experience there, start as a fresher in finance, and now sudden there is this opportunity where you don't have to do that. You can actually continue your expertise, play on your strengths, and go in for a career in finance, and then you can always complement it with some higher education, with CFA degrees. In general, there is the amount of educational materials that are available today is enormous, and individuals and should take advantage of that, absolutely.
Right, right. So, what kind of job profiles can we expect for people who have a background of, say, CFA plus data science?
So firms like ours is, we are a quantitative research firm. So we work heavily on large number of data sets, on large number of modules. So if you are more technology oriented, then definitely there are a lot of software engineering roles. If you are more data science oriented, there is and if you have a statistical aptitude, then the quantitative researcher is a very strong role, like looking at these data sets, applying your knowledge of finance, and then figuring out ways to extract alpha out of it. And it is extremely gratifying work, because you're working on very unique ideas, and then if you're able to then get an edge and make money out of it, that is ultimately what everybody is looking for.
Right. And as you speak about alpha being generated through AI ML, one basic silly question that comes to mind is, if alpha generation is easy, will everyone kind of copy the kind of thought process that we are working on, and ultimately will the alpha be wiped out?
Yes, you are absolutely right. That does happen, which is why when we started the slide on alternate data, we said the definition is vague, because what was alternate data 10 years ago is today market standard, because everybody is using it. Everybody has figured out that there is alpha coming out of that data set. And there are more. The vendors have also figured out that it is a very lucrative business, right? So the vendors are also going out and selling the data to as many people as possible. So you are absolutely right, that the alpha does come down. So there are two things that we need to do to be ahead of the curve. One is keep looking at the alternative data sets, more and more data sets, right? So that sourcing, I spoke about sourcing in the data funnel, is a very, very critical part of the alternative data set process, where we keep looking at new and new sources. And then the case study 4 that we took, right, which is very unique, not easily available, requires a lot of effort, is another way of keeping the edge. And the third way of keeping the edge is figuring out new ways. So if I look at credit card data, when people started looking at that, they said, okay, I will use revenues and I will estimate revenues from that, because I know real time. And now if the actual revenue comes above or below, there is or rather, I will estimate a revenue and then take a position based on what is market expecting. right? Now that today everybody is doing it. So there may be the market has already anticipated it, right? So now you have to think of it differently, make it look at the change in expectation, or is there a surprise factor around it? So evaluating, from using the same data set in a different way, using that creativity, that financial intuition to find, okay, is there anything more that I can find out of it, has to be done, right? And it will happen as more and more users use the same data set. Yes, the alphas keep going down.
Right. So, in fact, there are a couple of questions around the case study that you mentioned, that India is still largely an under-penetrated market, and only 3% of the population has a formal credit card, from a PwC report. How can the case study one be true or valid if only 3% of the population uses credit cards? And kind of there will be a lot of assumptions which are being used, and with limited data set, is there a scope of going wrong in that, and how reliable all these data sets are?
Yeah, that's a very good question and a very relevant question. So as we do spend a lot of time looking at these data sets from emerging markets. And what has happened in the emerging markets is that there is a leapfrog in the technology. So yes, you are correct. Credit card is not penetrated, but Paytm has, GPay has. There are other sources who are collecting the same data, right? So now if you can access that data, that alternate source, right, which is why the definition of alternate data itself keeps changing. So 10 credit card is was exciting few years ago. Today it's not, but in a country like India and a lot of the various emerging markets, there is data available in other forms, like the fintech apps, which sort of may provide some of the causal links around in a similar manner like credit card data.
In fact, when we talk about data, and a country like India, where there is a mixed economy, where there is a lot of cash, there is banking involved, multiple things, just 5% of the citizens are under the tax net. In that case, uh, when we are looking at data, what multiple data sets should one look at? And uh, when we talk about industries, typically when I was investing in private equity, a lot of times it used to happen that it was very difficult to find comparable companies, their data, profits, and valuing them was at times very difficult. So we had to do a guesstimation in terms of valuing and guessing the data largely. So that is where all this data, kind of, for a country like India, it becomes very difficult.
Yeah, that's absolutely true. I think it's in a way, if it is difficult, that sort of helps getting an edge, because if it is easy, everybody will access it. But we gave the example of fintech apps. There are examples of, for example, the data being collected by the online shopping apps with respect to various products which are being sold. There is data available with online grocery apps with respect to, okay, consumer goods that are being used. A lot of while still small. So you have to always understand that uh, no data set will predict 100%, but if it can predict the trend, and then there is a relationship with the trend and the revenues. So for example, let's take a retail company in India, a retail seller of clothes, for example, that is publicly listed. Now, using data set, you may find a very, very small user of people who shop at that particular shop uh, is using credit card. But then looking at that trend, if you find it's growing, and then you find, okay, yes, there is also a predictive power where the revenues of that firm are also growing at the same time, right? Then there is a causal relationship which makes sense, and then there is an alpha, right? So we're not saying, okay, we want to predict. It again comes to that financial ingenuity of how do you find that predictive power of what is working. So yes, you may not be able to predict the revenue itself, but can you predict the trend in revenue? Can you predict that, yes, we think that when the next uh, results will come out at the end of next quarter, because of what we are seeing in the credit card spend or online spend, we believe that there should be an increase with what currently the market is expecting. Right. Also, what you have to also understand is the real power of machine learning also is not just looking at one data set, but combining data set, looking at interaction effects. Right. So you may look at, for example, you may look at credit card data, come up with an estimate, but then you also want to combine it with what are the analysts expecting, what is the expectation on the street, and now is there a change in information, is there a dispersion in information that you can take advantage of, that gives you a better insight of, right? So it's so the non-linear relationships, the interaction between different sources of alpha, different sources of data set, is again where AI ML is extremely powerful. And historically, people, the advanced statistical techniques that were linear could not capture these interactions. Today, the models are capable of capturing it, which is why it is important that people realize that the things that can be done in the investment process is very high.
Right. So ultimately, it will be some kind of human invention, in the sense one has to come in between, uh, and analyze the data, kind of come up with the correlations, and kind of apply their knowledge, skills, and say that okay, these data sets are making sense, there is some correlation, and based on that come to some kind of a decision on whether to invest or not. So there is one question again on around that is, how can we distinguish between correlation and casual relation?
Very true. So I think that is where multiple steps happen, right? So that causal link, is there a hypothesis? Is there a scientific hypothesis? Uh, so typically we do not start any data set evaluation if there is no scientific hypothesis of, is there a relationship between the data set and the final variable? So that is step one. Step two is building a very, very robust infrastructure. So I mentioned in my alternate data set funnel, the step two was evaluation, which takes 40% of the efforts, right? And essentially having a very, very robust infrastructure that can test this relationship for robustness over time across data sets, making sure that the data models that you have built are robust, they are not overfitting, is a very, very critical part of this process. And I think that's one way sort of to avoid and have a robust outcome.
And in terms of programming language, it is kind of, now everybody knows that Python is there somewhere, even SQL is there, which people should know. Are there any other languages which one should learn to kind of hone their skills in this particular domain?
There are several languages, but if somebody is starting out fresh, I think Python is a very good point to start. It is open source. It is most widely used. There is a large number of libraries available. Almost every firm that provides data models, machine learning models, have APIs in Python. I think keep life simple. That is good enough for at least for several more years. I don't expect anything else to come even close to where Python is today.
And in terms of data provider, who are the major data providers and what are the kind of typical costs around these data sets?
So there is a large number of data providers available. I would not like to take specific names here, but if you Google any topic, if you're looking for certain data set and you Google, you will find. But again, one of the edge here also is, so when we started with the definition of data, we said alternate data set is a data set that is not created to capture financial data. So in an ideal world, you want to get a data set which was not created to be used in finance and then set it up for your own use, right? So the looking for data providers, identifying data providers, I can tell you it is, very also it is common to actually seek out people who have data where they have not realized they have data, and to ask them, okay, can you share this data with us? That actually needs to be done, to again keep the edge, because once a data provider has it, once somebody realizes that it can be monetized, then it starts becoming available to others, right? So there is the process, but in general there are still a lot of data providers, and it's not necessary that even if a data provider is found, everybody is able to take alpha out of it, because most people, a lot of people get the problem framing wrong of what they should be getting out of that data, and what should be they be predicting. So this is not just being used to predict returns. This can be used to predict revenues, growth rates. It is also used in risk management process. A lot of these things are used in portfolio construction, in dynamic sizing of your ideas and bets. So there are very large number of applications where this can be used. So even if people find good data sets, they are not necessarily able to derive alpha out of it, or sort
Right,
of use it effectively.
right. And since this is a career webinar, a lot of our viewers out here are interested in understanding if they are looking for a career, or maybe either a fresher or somebody who is looking to make a switch from the regular finance domain to something in the AI ML space. And typically, majority of them do not have the tech background. Then, how easy or difficult is it to make the switch, and what additional skill sets do need do they need to build on to make a move?
So my view is, if somebody has a tech, so in general, right, our strong view is this, that to succeed in general in finance, every individual has to play on their strengths, right? So if somebody is of a tech background, it makes sense to sort of stick to that, work on the data engineer roles, work on the software engineer roles, start with that. In parallel, build your statistical knowledge, build your ML knowledge, build your data science knowledge, and then go deeper into data science or quantitative research. If you are not from a tech background, my recommendation is, unless uh, so for example, if somebody is not from a tech background, they are then competing with a technologist who spent at least 4 to 6 years studying that. So now you need to ramp up on that, right? So my general advice is, do not, if you're a good footballer, don't go and play cricket, stick to football, right? My point, so what we recommend is, go into the financial analyst role, work on the data analyst side, trading side, work on the portfolio manager role. Those are the career paths that you can take, and you can still use a lot of the insights from AI. You can guide the technology team members in the right way of using it. It may be underestimated, but there is actually a lot of value. See, for the same example, the technology person, the software engineer or the data scientist is not a finance specialist. They do not understand the domain as well as you do. So they will play on the strength on taking your insights and building models out of that. So it is a collaborative effort where each person works on their strength and what they bring to the table. And in general, trying to switch is, then you're always starting at a disadvantage. That's something personally I don't recommend people. I ask people to play on their strengths, and then if you are really interested in a particular something else, build skills in that direction. It needs time. You need to go into depth. You need to be as well as good as somebody else who has spent years doing it. Else you will always be at a disadvantage.
Last couple of questions. One is with respect to passive investing. And when there is a major debate going around where a lot of index funds are now coming up, and people want to invest in index funds rather than active funds, will AI ML based investing make more sense compared to the regular active funds?
So what I would say is, the active funds themselves have to innovate and use AI ML to be better, to differentiate themselves, right? So it's not necessarily a competition between the two. This is the objective of this webinar, is that this is coming for everybody. And if you are saying I can avoid it, or it's not for me, then maybe you're missing the big picture and the big shift that is now happening. where this gets more and more integrated into our daily lives.
And in terms of, are there any books then one can refer to understand more about this particular domain?
There are several books. Uh, I don't, this if you again go on any of the Amazon, you would be able to find the reviews. Uh,
Sure.
there are a lot of courses. Now, I am personally a fan of courses rather than books. I started with the certification specialization. I mentioned that the CFA Institute provides a certification in data science. That is a good, simple certification process that is not very technology heavy, that allows you to understand what are different components. That's a good starting point. There are many other free resources that are available today, which can be used to sort of, and it's very widely, easily available.
We are completely out of time. Thank you, Nirav, for sharing your insights and sharing your knowledge on this particular complex topic and making it very lucid and making it very interesting for people to understand. As a reminder to our listeners, please do complete the evaluation survey that has appeared on your screen at the end of the session. CFA Institute and CFA Society India members may claim their PL credit by logging in their online PL tracking tool. Do look for our emails for our upcoming webinars. Thank you, Niro, once again for this wonderful webinar. Thank you.
Thank you so much for having me here. I appreciate this.